Now, before we move on, last week's class, we happened to discuss about spot markets and forward markets. Now, this is in continuation with the same, wherein you are going to learn about various codes and rates. So to start with, exchange rate. Now, what is exchange rate? Exchange rate is always a ratio which is in between two countries. Take the rate of currency, rate of any two countries, and the ratio of both those currencies will be termed as exchange rate. Next, direct quote. What is direct quote? It is a domestic currency on the numerator of the quote. The numerator, the above part, upper part of the quote is referred as direct quote. And indirect quote, it is just the opposite places, the foreign currency on the numerator of the quote. This direct quote is about domestic currency, whereas indirect quote is about the place of foreign currency. Buying quote. A currency denotes the rate at which banks buy the given currency. This is a currency. It is a quote which is been used while we transact with banks, and a currency which denotes the rate at which banks buy the given currency is called buying quote. Whereas selling quote is selling price at which banks sell the given currency. Whatever currencies bank is holding, if they want to sell at what price or at what rate they would probably sell it, that is referred as selling quote. We have forward exchange rate. Now, what is forward exchange rate? It is again a rate which a commercial bank is willing to commit to exchange one currency for another at some specified future date. It is a commitment made by the commercial bank on so and so date at so and so price, the currency will be exchanged. That is referred as forward exchange rate. Next, we have nominal exchange rate. Now, what is nominal exchange rate? This is particularly the number of units of a domestic currency that can purchase a unit of given foreign currency. That can be 1:5, 5:1, 10:2. It can be in any ratio. So domestic currency with foreign currency, when you are exchanging, that number of units that you get in exchange is referred as nominal exchange rate. This represents the value of two currencies at a particular point of time. Then we have real exchange rate. Now, what is real exchange rate? It is it all about the fluctuations which happens in the market. That is inflation. The rate which inflate, which is again here a real exchange rate refers to the inflation which is adjusted against nominal exchange rate. Real effective exchange rate, that's abbreviated as REER. Now, this particular rate is in weighted average of countries' currency in relation to an index or basket of other major currencies. The weights are determined by comparing the relative trade balance of country for country's currency against each country within the index. Once the rate is determined, then REER is calculated. Now, moving on. Now, let's begin with direct and indirect quotes. These two methods are used for quoting exchange rates. One is direct and the other one is referred as indirect quote. Now, what is direct quote? Just now we tried to understand. Direct quote is, gives a domestic currency price per a unit of foreign exchange. Suppose if India quotes the exchange rate between the rupee and the US dollar in a direct way, the quotation will be written as rupees 71.29 US dollars, again as the dollars. Now, in case of indirect quote, the value of 1 unit, of home, currency will be, one second. Now, so this is Indian rupees, and here this is dollars, US dollars. So, direct quote is all about the exchange rate between the rupee and the US dollar. Now, on the other line, indirect quote. Now, what is indirect quote? Indirect quote is the value of 1 unit of home currency representing in terms of foreign currency. The exchange rate, suppose in C. This is US dollar and this is rupees. Okay, so the exchange rate in example is quoted as US dollar 0.014 rupees. Direct quote places domestic currency on the numerator of the quote. Indirect quote is opposite of it. So, direct quote and indirect quote. In direct quote, you can see the numerator is being the domestic currency numerator is placed numerator in the numerator place, whereas in the indirect quote it is opposite of it. That is the foreign currency will be appearing on the numerator, and the domestic currency will be going the other side. Now, next we have few illustrations. Here you can see this is Australian dollar given the indirect quote. Now, in case if it is indirect, now if the quote, direct quote is this, that means rupees it is here. Okay, this is rupees and this is Australian dollars. In case if this has to be converted into indirect, then Australian dollar will become the numerator. That is the foreign currency will take the numerator's place and the domestic currency will go as in denominator place. This is the change. Okay, so 1 by divided by 48.4392, which is 0.0206444 rupees, Australian dollars. Okay, so similarly, if indirect quote is given and you are asked to convert it into direct, it is simple, reverse. Okay, suppose this is British pound 0.0115, again 1 divided by the same number. This is calculation. Now this is, here this is rupees and here it is British pound. Okay, so in indirect this will become the place will change. This domestic currency rupees will come this side and pound will come on the other side. Okay, so rupees 88.876 of British pound. So this is how you are going to write. Then next we have buying and selling rates. Now, what are the buying and selling rates? Just now in the beginning of the session, we have understood about the commercial bank, the role of commercial bank in buying and selling rates. Let's see in detail. Buying quote of a currency denote the rate at which banks buy the given currency, and selling denotes the the selling price or the selling rate at which the bank sell a given currency. The buying rate is known as bid rate, and the selling rate is also known as the offer rate or ask rate. Remember, the buying rate is also referred as bid rate, whereas the selling rate is also referred as ask rate or offer rate. Okay, then and to for in order to calculate these rates, the banks which are financial institution have to meet their operating cost. That means these transactions, when a bank is supposed to conduct, they have to take they have to incur certain operating cost, and they also need to make certain profits on these transactions. Therefore, the selling quote is always higher than that of buying quote. Hence, the difference between these two quotes forms the profits of the bank. Or in other words, we refer this profits here as spread. We refer the profits here in the language of international financial management. We call it to be a spread. Now, spread or the profit, so-called bank's profit on the exchange rates, buying and selling quotes, is equals to ask price, bid price. Now, what is ask price? What is ask price? Ask price is nothing but the selling price. What is bid price? Bid price is nothing but buying rate divided by ask price, again selling price, into 100. So this formula, all of you have to understand before you jump to solve the problem. Simple problems, yet logical reasoning. Okay, then we have another small illustrations to do. See here in this illustration, spread currency is spread is equals to 71.61 minus 70, which is divided by the ask price, that is 71.61 into 100, which is giving you the spread is equals to 1.365%. Now this, for any individuals and firms, the spread can be bigger or than the banks and financial institutions. Here, the individual or firm may buy the currency at higher rate and sell it at lower than quoted in newspapers or stock exchanges. Now, if you observe in the newspaper, you will find, and you will now be in a position to understand the rates which are quoted, what those are. Those are all the exchange rates, ask price, bid price, etc. Okay, the financial industry, then they may be, the spreads may be larger. That means the profits may be as bigger. Okay. Next, moving on. One second. Am I? Yes. Sorry for the disturbance. Yes, in continuation, let's do one look at this one problem of how to solve the bid ask spread if the bid prices are given and the yeah. So here we have a question on this, which is rupees 89.213 is the bid prices, whereas my 89.254 pound. This solution happens, you simply has to follow the formula which we have just seen here. The spread is equals to, spread is nothing but the bank's profit, which is equals to ask price minus bid price divided by ask price into 100. So here we apply this formula, that is rupees 89.254 minus 89.213 divided by again ask price, that is 89.254 into 100, which is coming to 0.046 percentage, which is the spread or the bank's profit. That is 0.046% is the bank's profit in this particular transaction of buying and selling. Moving on, we have another example. Find the bid rate if ask rate is given, US dollars, rupees 71.61 US dollars, and the bid ask spread is 1.365. Here the spread bid ask spread is given of the bank. Now here you have to find out the bid price. So again, take the same formula, whatever values we are knowing from the questions, just substitute those and try to find out the remaining. So moving on, we have ask price. We have ask price, which is rupees 71.61, and so we will be substituting here, minus bid price is what we do not know, so hence we will assume it to be X divided by 71.61 into 100. Okay, this is equals to this 1.365 percentage is nothing but the spread, that's bank's profit, which is already given in the question. So simplifying these equation, that is the 71.61 minus 6 divided by 71.61 is equals to, here this particularly 1.365 divided by 100, we get 0.01365. Again, further in simplification, this is 71.61 goes on to this side, and this is the value, that is 0.97747. This here 71.61 is simplified further to find out X, which is equals to 71.61 minus 0.97747, which is equals to 70.6326. Okay, so the bid rate is 70.6326. Next, forward market quotations. Now, what is forward market quotations? Now, this is a rate at which commercial bank is willing to commit to exchange one currency with that of another on a future date. The forward exchange rate is a type of forward price, which we learned in the last class. Forward rates are quoted for different maturities, such as sometimes it is for 1 month, 2 months, 3 months, and it can go up to 12 months as well. Usually these maturity dates are closer to month ends. Month ending only the valuation would be done, and then followed by these forward market codes are being published at newspapers and periodicals. The quoting rates can be expressed as outright codes or as swap quotes. The outright quotes for the US dollar in terms of the rupee can be written for different periods of different contract as follows. Suppose you see here the spot, is rupees 70.9275 1 month. Up, for 1 month it is 71.21, whereas for 3 months it is 71.68. Now the swap quote expresses only the difference between the spot quote and the forward quote, which can be written as follows, like this. Whatever the difference is here, okay, only that difference has been highlighted. This is 275 and this is 525. Okay, 9275, 525. Only the differences are being highlighted. Okay. Suppose if it can be written as for 3 months and for this is for 1 month, and it may be noted that decimals are not written in swap codes, so decimals are excluded in swap codes. Next we have premiums and discounts. Because they are future dated, sometimes you end up getting some premiums or certain discounts are also offered. Now how and what those are? Okay, now see, forward rate differential represents the differences of forwards and spot rates. This is also called as swap or forward rate differentials. And these are attributed as to the uncertainty factor which is associated. Unlike spot, it is not current, day or date. It is all about the future. So hence there can be this particular transaction is associated with some uncertainty, which may either lead to rise in the rate or increase or decrease in the rates. This can be attributed, this is all because of the future uncertainty which is associated. Hence the change in the forward rates can be upwards and downwards. Okay, and this disparity arises between spot and forward rates. This particularly is called as forward rate differentials. Now if the forward rate is lower than the spot rate, it will be a case of forward discount. See, try to understand. If your forward rate is lower than the spot rate, okay, if your future rate is lower than the present rate, then we call it as forward discount. On the other hand, if the forward rate is higher, it is a premium. Okay, than the spot rate, it is referred as premium. Now forward premium or discount, whatever it is, expressed in annualized percentage deviation from the spot rate, and this can be computed with this in a formula, which is forward premium or discount. Not always premium, sometimes it is premium, sometimes it is discount. Whatever be the case, the formula remains same. That is end day forward rate. That is what number of days later is the transaction is being planned to be planned for that date, n days from today, minus the spot rate, that is current rate, divided by the spot rate into 360 divided by n. 360 divided by n, here n denotes a number, length. Okay, n denotes the length of the contract, which is expressed in terms of number of days. Sometimes it is 56 days, sometimes 78. Like that, one has to calculate the number of days, and you have to substitute here the number. Okay, then we have for the above quotations, suppose for a 1 month forward quotations US dollar, the calculation of forward premium or discount is as follows. Suppose in the same previous example, if you continue, substitute these values. Okay, 360 divided by 30. Here the length of the forward contract in terms of number of days is 30. Hence it is divided by 30 here, and we get 0.0478, or expressed in terms of percentages, we get 4.78%. Okay, next see this illustration, forward differentials. You're asked to find out the forward differentials if the spot rate of US dollar is rupees 71.91 and 1 month forward rate is rupees 72. So your forward rate is 72, which we are substituting here in the formula, and we have minus 71.91 divided by again the spot rate, which is 71.91 into 360 divided by this being 1 month contract, it is 30 days. Okay, into 100. Now, after simplifying, you will be getting 1.50%. Of forward premium at being 12%. So whatever is missing, denote that missing as X and simplify with this formula, you will be getting that X. Suppose here in this illustration, it is forward rate of US dollar if spot rate is 71 and the forward premium is given. We are supposed to find out forward rate here. So let the forward rate be X. And remaining whatever information is given, let us substitute all that in order to derive and calculate the forward rate. And so on, we are here with the answer as 72.6291, which is the forward rate. Okay. Then we have, moving on, cross rate. Sometimes the value of currency is not known in terms of specific currency. Particularly, we do not know. In such case, the information on the currency is absent. Hence, one currency is sold for common currency, and again the common currency is exchanged with the specific currency. This particularly is known as cross, rate trading. Okay, where the currencies, two currencies are, where both the currencies, particular and specific currency, is not known. Okay, and the cross exchange rate between these two currencies is found out through their value in a common currency. And this exchange rate between currencies computed with reference to a third currency, usually the US dollar, is called the cross rate. The US dollar is considered to be the cross rate in such cases where the information on the value of currency is absent. Okay, we do not know which currency it is, then we apply cross rate, and this cross rate is all about the rate or the rate for which it is being traded between two currencies. We call it as to be cross rate, and we need here a certain in order to calculate this cross rate, we need a base currency, and for that an exchange rate between two currencies we do not know. Hence, a reference third currency is being used, and most of the time we end up using US dollars. Suppose stock exchange codes are this: rupees 71.91, rupees 72 US dollars, and it codes Canadian dollar as this. So, but does not code the exchange rate. Now, the rupee and Canadian dollar, we do not know the exchange rate here. Now, what do we do? We have to adopt the cross rates. That means US dollar. The third currency we resort to, which is US dollar. And in order to calculate this, here again, the selling rate, spot cross rate is calculated, wherein the selling rate of the Canadian dollar in India can be the selling rupee for the US dollar at rupees 72, and then buying Canadian dollar with US dollar at rupees Canadian dollar at 0.75. Now, how this calculation is done is shown below, like this: $72 rupees 72 US dollars into US dollars 1 divided per Canadian dollars 0.75. So here cross currencies is calculated with this, and finally combining those two, you end up getting this value of rupees 95.37 minus 95.9976 Canadian dollars. Okay, next moving on to forward cross rate. What is forward cross rate? For the calculation of forward cross rate, now the above is spot cross rate. Now this is forward cross. Spot is currently you know the values, and so you are able to do. Now in case when you are transacting about forward rates, that means future rate, then how do you do? Okay, here is one example. To solve to calculate the forward cross rate. The forward selling rate of the common currency is divided by the buying rate of another currency, and so on, vice versa. So here you can see bid rate and ask rate. So you find rupees euro exchange rate if the 2-month forward exchange rates are 70 rupees 72 and 72.2 US dollars, and euros in US dollars are given. So with this information, we can find bid rate and ask rate. Okay, so here we move on to the nominal, real, effective exchange rates. In this unit, completely you're focused to learn only on calculation of various rates, that is cross spot rates, forward spot rates, what is cross rate, exchange rates, cross currency rates, etc. Nominal exchange rate. Now, what is nominal exchange rate and real exchange rate? These exchange rates that are published through stock exchanges or newspapers are nominal exchange rate. Now, next time when you happen to watch the newspapers or the places where even mobile applications also, when you are watching, you will be able to locate and identify them as exchange rate. These are published by the stock exchanges, and these are referred as nominal exchange rates. These are defined as a number of units of the domestic currency that can be purchased as against a unit of a given foreign currency. Basically, this is a ratio between the two currencies at a particular point of time. Then we have real exchange rate. Now, what is real exchange rate? It is the inflation adjusted nominal exchange rate. So here a consideration of either up, increase or decrease in the rates are taken, and a rate is fixed, which is considered after inflation is being taken into account. So real exchange rate is inflation adjusted nominal exchange rate. The relationship between nominal exchange rate and the real exchange rate can be expressed here in terms of E of R, that is exchange rate is equals to E of P divided by P, where P and P star here you can see are nothing but the domestic and foreign price index. Okay, if the price index in India and the USA rises from 100 in the year 2000 to 130 and 120 respectively in the year 2018, and if the nominal exchange rate between two currencies between the two dates remains 72 US dollars, the exchange rate will be here the same formula, that is the exchange rates. And the exchange rates are E of P, that is P, which is domestic currency, which is 72 rupees into 130 being the inflation, that is divided by 120. It is rising up to 120 in the year 2018, which is divided by again 120 respectively. This is equals to rupees 77.999 US dollars. So the exchange rate, domestic rate of 1 rupee against the other currency is denoted, is calculated. Now the floating rate regime. Okay, the floating rate regime is all about the nominal rate, which gets adjusted automatically with a change in the price level. This usually happens due to various market forces. And in a fixed rate regime, the exchange rates are administered, and hence the nominal rates are do not adjust to the changes in the price level. Hence, there will be some gap between nominal exchange and real exchange. Okay, and these gap are because of the price level changes. Okay, by using the same formulas also you can identify change in the nominal exchange rate, etc. Okay, then we have exchange, effective exchange rate. Now, what is effective exchange rate? That is REIT. It is a weighted average of country's currency. It is all about a weight which is assigned by the country's currency in relation to its index or basket of other major currencies of that country. These weights usually are determined by comparing the relative trade balance of country's currency against each country within the index. Now, determination of exchange rate in the spot market. Spot market are the current markets. How the rates are determined. Here you can see the exchange rate, that is rupee, and the US dollar depends on the demand for US dollar and its supply in Indian foreign exchange market. Suppose a demand for foreign currency comes from individual or business firms who make payments in foreign currency for the import of goods and services, or not necessarily always to be imported. They can also end up making certain investments in foreign security. So this way, the demand and supply of foreign currencies, happen. The supply of foreign exchange results from the receipts, of foreign currency on account of exports or inflows of foreign investments. So here we have demand for and supply of US dollars, the demand and supply, which is shown here with the help of a graph. Now, higher the value of US dollar make Indian exports cheaper. Okay, the more the US dollar prices are, the value is increases, the lesser the exports would become. Thereby, this even stimulates the demand for exporting. The equilibrium point exchange rate is where the supply curve intersects at Q1. Okay, and here the rate, 1 second here, this is a point of equilibrium where your the Q1, the rate at this quantity demanded is P1, and the change in quantity demanded to is Q2. Okay, Q2, and the price for the US dollar also changes to P2, wherein the demand and supply, both the conditions for a given foreign currency, given exchange causes the exchanges in the exchange rates. Now we have, after learning about various exchange rates, let us now look at the various factors which have direct or indirect influence on the exchange rates. The various influences that increases or decreases the rates. And number one is inflation rate. What is inflation rate? A country with lower inflation rate than another country will see appreciation in the value of the currency. And the price of goods and services increases at very gradual rate, whereas where the inflation is low. Okay, when the inflation is high, it increases at a very speed, very high speed than that of the low. It happens to gradually increases. A country which is having consistently a moderate inflation rate will always shows excuse me, rising currency value, while country with higher inflation typically sees depreciation. Okay, and its currency is usually accompanied by higher interest rates. And now, what is interest? And now, the interest rate is another reason because of which the rates, increases or decreases. The change in the interest rates affects the domestic country's currency against the foreign currency. Now, see, forex rates, interest rates, and inflation. All these are correlated. Okay, increase in interest rates will have a reason for increase in country's currency, and it will because of the higher interest rates, the higher rates are provided to the lenders, which further attracts more foreign capital because the lending rates are high. When the lending rates are high, people may come forward to invest. So, which is again a rise in exchange rates. So, this is one of the reason for the interest rates. If vice versa, in case of the lending rates are low, nobody will be interested. I mean, very few of them would be interested in investments as compared to the lending rates when they are high. Now, country's current account and balance of payment. Last class also we have been learning, learned about balance of payments. Now, a country's current account reflects balance of trade and earnings on foreign investments. Now, a deficit in current account due to spending more of its currency on importing products than it is earning through sale of exports causes depreciation. Hence, balance of payments of a given current country is one of the factors that influences exchange rates. Next, the major influencer is government debt. It is a public debt or a national debt owned by the central government. When a country with high government debt is less likely to acquire foreign capital. Now, when there is, no foreign capital or minimum foreign capital attracting minimum foreign capital, then definitely the inflation will, emerge, and this state, it leads to inflation. Foreign investors will sell their bonds in the open market, and because the government is in debt, and this shall result in further decrease in the value of the exchange rate, because all your values are going down. Your government itself, your country's government itself is in debt. Whatever foreign investment you had till date will go all, people start liquidating it. And once it is started liquidating, it will have impact on your currency, your exchange rate. Your exchange rate will be reduced, decreased. As a result of it, it has an impact on the exchange rate of the country. Then we have terms of trade. What is terms of trade? Related to current accounts and balance of payment, the terms of trade is a ratio between export prices and import prices. This results in higher revenue. Suppose a country's terms of trade improves, its export prices rise at a greater rate than its import prices. This will result in higher revenue, which causes higher demand for the country's currency and an increase in its currency value. Political stability and performance. Political stability and performance also plays an important role about on having the influence on exchange rates, like economic performance and the various ways to make the currency strengthen performance of the country on a global platform. All these makes a lot of difference and influence the exchange rates. Increase in, supposing a country is successfully able to increase its foreign capital, and it leads to an appreciation in the value of domestic currency. A country with sound financial and trade policy does not give any excuse for uncertainty in the value of its currency, but a country prone to political confusion definitely would have to see or experience the lows, that's depreciation in exchange rates. Recession. When a country experiences a recession, its interest rates are likely to fall, decreasing its chances to acquire foreign capital. As a result, the country's currency weakens, and this as in comparison with other countries, lowers the exchange rate. Speculation. Speculation is in other influencer on the exchange rates, wherein the investors will demand more of that currency in order to make profit in the near future. As a result, the value of the currency will rise due to the increase in demand. With this increase in currency value comes a rise in the exchange rate as intervention by monetary authorities. Now there could be a lot of interventions from monetary authorities, because of which there may be influencing the market, through which the buying and selling of currency happens, and further it leads to the exchange rate differences. Unknown factors. Some factors are known and some factors are untraceable, and any other factors which are unexpected events and definitely have influence on the exchange rate. Suppose we call it to be, because of this, the rate of exchange has got disturbed or increased or decreased, then definitely we consider it to be a factor, and they can all be summed up on under the head unknown factors. Next topic we have determination of exchange rate in forward market. Now, how do you determine the exchange rate in forward market? The formula for this is given, that is F is equals to S into and so on. Here we see F is a forward exchange rate. This is in terms of domestic currency, as again is the foreign currency. S here is denoted as spot exchange rate is denoted as S, and again this is in terms of domestic currency per unit of foreign currency. I of D is domestic inflation rate, I of F is foreign inflation rate, N is the number of time periods. Now here we have an illustration. This is the last illustration here. Exchange rate between US dollar and British on 1st January 2012, where was dollars 1.5507. And you see here, whatever values are given with respect to inflation rate and interest rate in UK, where it is 2.8% and 3.3%. Okay, 2.8 inflation rate, interest rate in UK is given as 3.3%, and the exchange rate is given. Now we are supposed to estimate the forward exchange rate between these two countries, okay, US and British. Now this using the interest rate parity. We have the formula, the same formula, the above formula. The values are to be substituted and simplified. So here we end up getting the actual rate is depreciating. Here you can see 1.554. Here this is 1.5401. This is relative purchasing power and this is interest rate. Power parity. Okay. So with this, we understand that US dollar has been depreciated more than predicted by the relative purchasing power parity and interest rate parity. So very simple problems on calculation of forward exchange rates, spot market exchange rate, cross spot and cross forward, interest rate parities, relative purchasing power parity, etc. Okay, so with this, this unit is come to an end. So in this unit, mostly the concentration should be on learning the various concepts of exchange rates, followed by concentrate on solving the simple problems of on the way calculation of ask prices, bid prices, exchange rates, etc. Okay, so thank you. With this, we end this session.